pleasure tonight of talking to James Lavish. This guy is a very smart dude. And he's one of the he's with the general partner of Bitcoin Opportunity Fund. He comes on my show every now and then, and it's a great chance to learn from this guy. And then we also have Corey Clipson, the CEO of Swan. So let's get rolling here. I think a lot of people have been wondering what's going on with banks lately. It's been pretty strange. I've had conversations with people coming to us for the first time. Some of these folks are very wealthy. Never before really probably been very scared about what's going on or even concerned. And starting to have some conversations where people are starting to scratch their head and ask some questions. So that being said, James.
Sir.
Since March, it seems like it's been a seemingly continuous stream of bank failures.
And it has.
Yet, equities have held up. Market seems to be shrugging off this for the most part. What's your take on what's going on as far as the banking system right now?
Well, I mean, first of all, thank you for having me. Appreciate it. And but the banks, what's going on with the banks is not what's going on with the markets. So let's just, first of all, put that on the table. Okay, but starting at the very, very, very high level, what's happening is we have a massive amount of leverage in our system, and that starts from all the way at the top. We have over 130% debt to GDP here in the United States. That means that the United States owes 130% more than they make every year. Okay, so that's a major problem. So that's number one. So it starts there, and it goes down to companies, and it goes down to individuals, credit card debt, mortgage debt, whatever it is. We've got a lot of debt in the system. So it's super, super, super leveraged. So the problem with the banks is that they're also super levered. And if you just step all the way back, and the simplest thing to understand is that when you deposit money in the bank, that is a loan to the bank, right? So that is not your money anymore. You have given up the right to that money, and now it's theirs. And they've promised to give it back when you want it. And what people are waking up to is that the banks then take your money and they lend it out, a whole lot of it. They lend out 85% of it to other people. So Corey could make a deposit in the bank. I'm the bank. I take 85% of the deposit, and I loan to Alex, and then he'll loan it out and he'll give it to another bank, and then that bank will loan out to somebody else, and it just keeps happening over and over again. So these banks, they don't have enough money sitting in their accounts, in their reserves, to give people their money back. And so that's what we're seeing, is that people are starting to get nervous about that. And so we just saw it happen with Silicon Valley Bank. There's a lot of problems with the system being operating on that kind of leverage. And then, and so the problem is that once you have interest rates move, you have what's called interest rate risk at the banks, and that affects the bank's balance sheets. It affects how they can make money. It affects how they can hold their assets and keep their balance sheet strong or not. And what we're seeing is that some of these banks are not managing their risk well, and some of them are not managing at all. And so that it's a major problem. And it's called fractional banking. And so the big issue, though, is that we're seeing some of these banks that they had been trying to fight what we call, this is a lot of information. So if anybody has questions and wants me to just slow down,
we're going to do Q&A also at the end. So if we're losing anybody,
I could just go on about this forever. So, but the problem is, starting at the beginning, the problem is we've been manipulating interest rates. The central banks have been manipulating interest rates and the money for so long, and they've been keeping interest rates so low, and we call it ZIRP, zero interest rate policy, right? And so it's really challenging for money managers and for banks to make money in that kind of environment. And so they are doing things that they're taking on risks they shouldn't take on. Okay, so the Fed just did their own review on Silicon Valley Bank, right in their backyard here, right? They just did their own review and what happened with that bank. And, you've heard me talk about this before. One of the big things that happened is, the Fed, trying to fight inflation, they skyrocketed interest rates. You guys have always been watching this, from just above 0% to just over 5% in less than a year, in about a half a year, right? They just jacked up rates straight up, right? And
this is a problem for the banks. Why?
Okay, so there's a problem for the banks in a couple of reasons, right? So that what happens is, when you look at yields and you plot them out on a yield curve, and you've got the really short duration, which is like overnight or 1 month or 3 month rates, and you go out on that yield curve to like 2 years, 5 years, 10 years, 20 years, 30 years, the interest rate at the end of that range should be higher than the beginning of the range. Why? Because if you're loaning somebody money for a longer period of time, that's a higher risk to you, right? So you want a bigger interest rate to be paid to you for loaning them that money. But in this kind of environment where you raise rates that quickly, the market knows, they can't stay there. And what the Fed is doing is they're engineering a recession. And so at the end of the curve, instead of those rates being higher, they're lower. So you have what's called the inverted yield curve, where your rates at the short end are higher than the rates at the long end. They're lower, right? Because the market expects the rates to come down in the future, okay? The problem with that is that banks, they make their money by borrowing from you short term and loaning to others long term, right? So they're borrowing from you, or borrowing overnight from other banks, or borrowing from the Fed, and they have to pay a higher interest rate than they're making on the long end. So that's
bank failures.
So that's the one problem. The second problem is, when they take your money in, okay, so they take your deposits in, and they keep that reserve. They keep part of it in reserves, in their own cash reserves. Well, they have to do something with those reserves, and they typically will buy a mix of assets. They'll buy short-dated treasuries, they'll buy long-dated treasuries, they'll buy mortgage-backed securities, whatever. The Silicon Valley Bank, what they did is they bought mostly long-dated treasuries, okay, and they didn't have a mix of investments in their reserves that matched their deposit base. What do I mean by that? What I mean that is, banks have a mix of clients, right? Well, Silicon Valley Bank had most of their clients, their big clients, were in the tech world, the tech industry. They were venture firms, they were venture capital firms, they were tech companies, they were startups. And so these are companies, these are corporations. And they have cash needs that are big, often, right? Which means that you need more liquidity at the short end. You need to be able to give them their money when they ask for it, right? Well, they didn't match that. What they did is they said they made the bet that not many customers were going to ask for their money back on the short end, and they loaned it out, right? And so what they did is they bought these treasuries that were long dated. Well, why does that matter? Well, it matters. Remember, we were talking about how the Fed just jacked up rates 5%. What happens to a bond when rates go up? Well, the price of bonds goes down, right? Because the price of the bond has to compensate for that higher interest rate. And the only way to do that in the market is by that bond trading at a lower price in order to compensate the buyer for a higher yield. So that means that those bonds went lower.
Okay, so
Right.
so in layman's terms,
Right.
the assets suck and bank failures.
So in layman's terms, the assets that they held in reserves that were ready for the customers, so they didn't hold enough assets. That's number one. Number two, they bought long dated treasuries, which were they were susceptible to the interest rate rises, which means that those bonds were worth less in the market. So when the customers asked for their money and the bank went to go sell those bonds, they were worth 30 to 40% less than when they bought them.
So like I said, the assets suck and bank failures.
Exactly.
All right. Glad we established all of that. So I think what people are actually wondering at this point, is this like a temporary thing, or are we going to see a lot more of this?
That's maybe what the Fed would say. Well, they keep saying the banks are fine.
The banks
right?
are sound and resilient, is what I heard.
Right.
Is this true?
Yeah, Powell and Yellen keep saying that, but we all know that's not true. We've heard this before. We heard that there was no housing market bubble back in 2008, and we heard that inflation was transitory, and it's all bullshit. We know that, and they're lying. And they're lying because they can't let people know that there are cracks in the system. So the answer is no, we just saw First Republic fail. So, going back to Silicon Valley Bank, this is what's important about this is that we realize that they had poor risk management. They didn't hedge out that. You could hedge that interest rate risk. You could buy hedges. They bought hedges, but then they made the bet that there wouldn't be interest rate rises. And so they took the hedges off. That's the second thing they did. The third thing they did was when their internal models showed that they were susceptible to these problems with rates rising, they changed the model. Instead of fixing their balance sheet, they changed the model.
So they're lying.
But the problem with that is, and what it tells us is that the Fed allowed them to do this. The oversight of the Fed was so poor that they allowed them to do this. So there isn't any strong oversight from the Fed. So if you think that the Fed is overseeing these banks and this one just slipped through the cracks, no, wrong. So the problem is, we just saw it with First Republic. Now, First Republic made a lot of loans. They made $20 billion of loans in LA, San Francisco, and New York alone to super high net worth clients, right? And they were buying huge jumbo mortgages, and these things went underwater. And so they became pretty much instantly insolvent as soon as people heard about this and were going to take their deposits back. I mean, they were upside down. So now we're hearing about PacWest. I don't know the situation with PacWest, but I wouldn't be surprised if there is a balance sheet issue there as well.
More bank failures coming or not?
I would be surprised if there are no more bank failures.
How long does this last, and how bad does it get?
Well, how bad does it get? Well, what the Fed and the Treasury are telling us, what they are signaling to us is they're not going to let it get bad. They're going to rescue these banks in some way, shape, or form. And so they refuse to say that it's QE, quantitative easing. They're not printing money. They're just, they're targeting specific situations to make sure that they don't get worse. But in reality, they're injecting liquidity into the markets to shore up these banks in ways that are absolutely adding money to the system.
They're picking winners and losers.
Correct. And so what is happening is these smaller banks, the depositors are fleeing those banks, and they're going to the JP Morgans, the Wells Fargo, Citibanks. Why? Well, because those they're deemed as too big to fail. And so if you have your money at one of those banks, you know that the government, the G20, the 20 countries in the G20 have agreed that there's a list of banks that they put out, and those banks are on that list, and they cannot fail. Okay. Because if they fail, they're systematically too important.
So Yellen was in an interview the other day. There was a congressman asking her questions, and he was saying, okay, so what about the regional banks in my state? What are you guys going to do if the regional banks in my state fail? And her answer, paraphrased, was, well, we'll pick who gets bailed out and who doesn't, basically.
Yeah.
Right?
Her answer was we will not guarantee every bank.
Right.
Right.
Okay. So here's the question then. If there is a regional bank that's too systemically important to be allowed to fail, but is too big for a JP Morgan to buy, what are they going to do?
Print
how much?
a lot. They will print so much money, it'll make faces melt. And the reason is they can't get out of this. Look, the United States, we're not the only country, I mean, it's happening in Japan, it's happening in the UK, it's happening in Europe. Like the sovereigns are under such a mountain of debt that they can't get out of. There is no choice, right? So their choice is to print more money, right? So what they'll do, and what the Fed is doing, and I can't get into Powell's head. I have no idea why he even took this job. It's an impossible job. But there he is, trying to be Volcker, and he's not going to be Volcker. It's just he can't be Volcker. Volcker he was the head of the Fed back in the 80s, who was able to jack up interest rates up to 18-20% to stop inflation. If we jacked up interest rates 18 to 20%, what do you think would happen to the United States?
That wouldn't be very good.
It would fail within a year. I mean, it's impossible. There's absolutely no way that they can do that, right? So they can't battle inflation. What can they do? They can push down the market to say that they're battling inflation and keep it from getting away from them, right? But they're going to engineer a recession. It's virtually a lock. It's like Bloomberg has their models say it's 100% lock. If you look at yield curves, they're inverted. It signals a recession almost 100%. It's like 99% surety, right? So at least in the modern era. So it's happening. So what are they going to do? They're going to push the economy into recession, and then they can't let it get too out of hand because of all the debt. So they've got to make sure that they get revenue back. So how do they do that? Well, they inject liquidity into the markets, which means they print money, they monetize their debt, which means that they buy U.S. treasuries to make sure that there's a market for them and to keep money into the system. So when banks go to sell treasuries off their balance sheet, the Fed is there to buy them, which puts cash back into the system, which is saving the markets, printing money, and causing what? Inflation.
All right. So for people who are still trying to figure out why the prices of everything tends to double every 10 years, this whole printing thing, I've heard, James, I've heard you talk about this. I've heard Lawrence Lepard talk about this. I've heard Mark talk about this debt spiral thing. And not to frighten anybody, but just, and for those of you who want to talk technicals later, corner this guy. He loves questions, right? But is there a way out of this?
No, there's absolutely no way out of it. If you ask Lynn Alden, she'll say that she's done studies on it. Any country, any sovereign that gets over 130% debt to GDP is cooked. That's it. You're done. You can't get out of it. So what happens? Well, the problem is we operate in a deficit, right? So anybody who has not heard me say this, anybody who has heard me say this, sorry, I tend to repeat myself on this, but it's important to understand. The United States they have so much debt that every year, since we're operating at a deficit, we can't pay off that debt, right? So what happens? The place is falling apart, Corey. I'm falling off the chair.
Tech support.
So if you're operating in a deficit, that means that we owe more than we take in. Okay, so the U.S. government doesn't really have revenues, right? They have taxes. Taxes are just collections. They're collecting revenue from you guys. The productivity is from you, and they're collecting that, right? But they're borrowing so much that they can't even pay that off every year. They have to borrow more. Why? Because the debt matures every single year, and they've got to give money to the debt that matures. How do they do that? If they don't have enough money that they're making, that you all are making, that they're taxing, then they have to borrow more. And it's just, you're in a cycle where you have to borrow more at higher rates, and then you're operating in more of a deficit. And the bottom line is the U.S. Treasury has admitted this. They put out a report a few months ago that was titled it was a review of the 2021 Treasury balance sheet or the financial position, and the subtitle in the report was it was an unsustainable fiscal path. and it showed
Very reassuring.
It showed U.S. debt to GDP in a straight line up, and they know that they can't get out of it. It's virtually impossible.
Okay. So we're running short on time. We're going to wrap this.
I want to do two things here.
The last point of that was that
Okay.
they have to have inflation. They have to have inflation, and there's no way around it. That's the point. Does that make sense?
It does. Okay. I want to make all of what you just heard tangible and kind of bring it home for the folks in the audience here. And
Real
one
quick,
point,
if anyone has a white Tesla, the parking enforcement is there. You might want to move it. Sorry.
White Tesla. Oh, Andrew, bro. Dude, we try to run a tight shop around here, man. Come on. Wait, half the crowd just left for their white Tesla. Welcome to
There's a
LA.
lot of white Teslas around here.
Look, it's hot out. The white, doesn't let the sun make it hot. And anyway, you could be in the car for 3 hours. Might as well self-drive. So two things that I think are interesting here. And the first is related to stocks, and the second is related to Bitcoin. And was it earlier this week? Earlier this week or late last week, I was actually talking to a pretty high-powered financial advisor who handles a lot of like rich folk and athletes and stuff like that around LA. And he was telling me that stocks go up 10% every year. And that it's basically something you can count on, and that's why you should have 60% stocks at least in your portfolio. And, you can talk about Bitcoin, but you really shouldn't have, totally irresponsible to have more than 10% of your liquid assets in any one area other than stocks, because, that 60%, I guess. Anyway, the funny thing is, when the things that James and Alex just talked about happen in an economy, that breaks. So from the early 30s through the mid 70s, the stock market was flat for 40 years. The stock market in Japan has been flat since the early 90s. And so, it doesn't mean it's flat. It went way the F down and then crept its way back up, over 40 years to get back to where it was. So that isn't something that you can just count on, because we've had this incredible sort of bull market in assets across the board from the early 80s through now. So that was kind of the first point, is that the model, just because it's worked for our adult lives, we've seen historically that when these types of conditions have occurred in any other economy, this model of up only breaks. The second thing I wanted to talk about is just kind of, for those of us that care about Bitcoin and kind of charting a path for what happens here over the, kind of the near term. I've been talking about this a little bit lately on some shows, but I don't think everybody here has probably heard it. I think what's interesting about this banking crisis beginning in early 2023 is we're already seeing receptivity to the Bitcoin story and what Bitcoin is and what Bitcoin does and can do on the levels of what you would normally see in the blow off top of a bull market. So this is, very similar to what you would have seen, in mid to late 2021 or at the very tail end of 2017 or something like that, where Bitcoin is on tip of everybody's tongue. It's on TV every single day. Smart macro people are talking about Bitcoin. Politicians are talking about Bitcoin. It's in the news every single day. And so what I think is really interesting about Bitcoin being, 60% down from all-time high, with plenty of reasonable folk, I think, having the correct expectation that at some point in the next few years we'll see another bull market that recovers all-time high, is that we actually have an opportunity for the first time ever for an extended adoption bull run, meaning number of people go up a lot, because we actually have a chance for like a 24 plus month bull market where we'll be adding new Bitcoiners every day, every week, every month. And what happens with price is going to be, alongside that, and also in some ways like a derivative of that. But I think it's just going to naturally happen. The last time we saw a banking crisis that mattered at all to the West was frickin' Cyprus in 2013. There were 0.1% as many people that knew anything about Bitcoin as today, and it was just Cyprus. This is the United States, and 1,000 times more people know something about Bitcoin. So I think this moment in time is really, really interesting. We at Swan have gone kind of full throttle and accelerated our plans dramatically, hired most of the people that we planned to hire in the second half of the year already, we're launching products that we weren't planning to launch till next year, like now. And that's why, because this is my base case, is that we're in the early stages of the biggest adoption bull run in Bitcoin history.
Okay. One more quick question for James, and then we're going to open it up for Q&A. I would like to suggest that if you're fairly new and you want to know about Bitcoin, we can ask some very basic Bitcoin questions. If you guys don't mind, we'll be kind to you, I promise.
Oh, I'd also like to suggest that find Terrence, who will be over there watching the Lakers game, if you have beginner
Terrence,
questions.
where are you?
There, he has a
Everybody
yellow
look
Lakers
back
hat.
there, hand up.
Okay, there's probably no one on earth that has answered more beginner Bitcoin questions over the last 3 years than Terrence Yang. I'm talking thousands of hours on Clubhouse and Twitter Spaces and on client calls.
Yeah.
So he's going to add to that total.
You're also welcome to ask any Swan. We're all more than happy to help you. Okay. So last question to James. After we've discussed everything we've discussed tonight and scared the poop out of a third of the audience, if you had 2 minutes to talk to somebody who's new to Bitcoin, thinking about Bitcoin, not sure about whether they should do it or not, what would you say to them?
Well, I mean, in 2 minutes, it's pretty simple to get people to just look at their receipts and realize that everything that they've bought in the last few weeks is double what it was just a few years ago. Right, so it's really easy to understand that your money is broken. The U.S. dollar is broken, and it's being manipulated against you. And Bitcoin cannot be manipulated. Yes, it's volatile, but it cannot be manipulated. So it is trustless. It's decentralized. It's anti-inflationary compared to the dollar, right? And it's super easy to move in and out of. And if you just put just a few percent of your net worth into it, just start with just a little bit, 1% of your net worth, then you know, Greg and I talk about this a lot. It could be an insurance policy against a basket of fiats, meaning if your fiat collapses, if you're not in the United States, or even if you are, and it becomes so manipulated that they do what I think they're going to do, which is let inflation run absolutely out of control and print so much money that everything around you is worth less. It's just worth more in dollars, meaning your dollars are worth less. If you own a hard asset like Bitcoin, then you can have something that offsets that. And you can save your hard work that you're storing as money in an asset that cannot be confiscated.
Aloha.
So the price of Bitcoin goes up.